Good morning. Welcome to another episode of The Curious Investor. Today, we're going to compare the lead and the leash and how risk might be a big deal and how to pay close attention to the math of risk. Before we jump into it today, let's take a look at the disclaimers to make sure you know that you are safe, because there is no safety in the stock market. The stock market is risky. There is guarantees that you're going to lose money. There's no way to invest in the stock market without losing money. And so this is not for the faint of heart. So please pay attention and realize today, if you wish to remain unidentified for a recording, please remove your name and your face from the screen. We have no crystal balls. These are simply our opinions. Stock investing includes risk, including fluctuating prices and loss of principal. Dividends are not guaranteed and may be reduced or eliminated at any time by a company. Following information is not a recommendation in relation to any named securities. Any references to specific securities are for illustrative purposes only. Content provided at this event is for general purposes only, not intended to provide any specific investment advice or recommendations for any individual. Any performance references historical, and there is no guarantee that it could ever be done again. All indices or unmanaged may not be invested into directly. Any economic forecast set forth during this event may not develop as predicted, and therefore can be no guarantee that any strategy will be successful. These thoughts and opinions are those of Gimbal Financial and do not reflect LPL Financial. Securities offered here are offered by through LPL Financial, a member of FINRA and SIPC, and then finally, investment advice offered through Gimbal Financial, a registered investment advisor, and we are a separate entity from LPL. So there you have it. Those are our disclaimers. Anytime you think you want to invest in the stock market, no, you're probably going to lose some money, but that's part of the deal. You need to really grasp that idea and pay close attention. Today, I want to talk about a couple different principles. One is the lead, and the other is the leash. And a lead is simply a way to lead your dog. This one is compliments of the old time Scotch Collies and the Northcutt farm. They gave this one to us to help us train our dog, but it can't be more than 4 feet long. You simply slip this around the neck of your dog and apply a little pressure, and the next thing you know, you're leading them with this thing. Properly used, it'll have slack in it when you are leading your dog where they need to go. This is the leash. Many of you have seen this. It's spring loaded. It's got a lock on it that keeps it. And this thing probably unwinds 20 feet. So the dog can go as far as it wants and can lead you wherever it chooses to. And dog trainer Wendy Vollard had a quote that she said, you lead your dog with a leash, and your dog I said that wrong. You lead your dog with a lead, and your dog leads you with a leash. And so why I wanted to use these examples today is because we're going to talk about the importance of understanding the math of a loss. And if you don't use something like this to stop your losses, if you don't put a leash around your losses and you just allow them to begin to expand and expand like a leash does, then all of a sudden your portfolio is going to be driving you instead of the other way around. And that can be very dangerous, very emotional, and not very fulfilling. So let's go back. A few weeks ago, we talked about tennis balls and eggs, which ones you wanted to invest in, and whether one was better than another. And so the math of a loss is just, we can use this same prop to walk through that. The math of a loss is a big deal. You know, if you had 3 tennis balls and you let one of them slip away and it's gone, you've lost a third of your portfolio, and that's not a very good plan of action. So you want to pay close attention to the math, and let's take a look at that, and let's consider that before we go too much further. Keep in mind that sometimes when you see something where you've had a loss, somebody will tell you, well, that's only a paper loss. Well, your money is made of paper, and that's a real loss when your money is no longer in your account. So whenever somebody says it's a paper loss, they must not value the money as much as I do, because any drop in your account value is a real loss. It is not coming back unless something changes in the portfolio, and it may be the change of the economy, it may be change of the stocks that you have in it, but to simply ignore what you've lost and act as though it didn't happen probably will lead you to further losses. And let's talk about the math behind it. I got a stack of coins here. These are old-fashioned dollar coins, and there's 10 of them here. And suppose I let this stack of coins drop to 9. Suppose I went from 10 to 9, and this one is lost. I now have 90% of the money that I had just a second ago, and that's a real loss. So dropping from 10 to 9, I had a 10% loss. But if I want to go back from my new 9 coins to stack it back up to 10, guess what? These 9 are going to have to work harder just to get me back to break even than the 10 would have to do to get me to 11, because to go from 10 to 11 is 10%, but to go from 9 to 10 is an 11.1% gain you're going to have to gain. So the loss is more painful than the gain. So to get back up to that, I'm going to have to see my money grow at 11.1%. That is not the most productive math in the world, but just keep in mind that the way you do the math on that is you take what you lost or what you want to gain. We lost one, we want to gain it back just to get break even. If you divide 1 by the 9, that's going to get you your 11.1% gain that you need to break even. And that's not completely unheard of. A lot of stocks will trade in that range of 11% in a week or two. So there's a number of opportunities to try to recapture that loss. But let's look at another example. Suppose I do have 5 apples here. Just don't have big enough hands. So I've got 5 apples, right? See them all? Now, if I lose one, I now have 4 apples. The 5 drop into the 4 was a 20% drop in value. No big deal, 20. That's going from 1,000 to 800, or that's going from 100,000 to 80,000. That's a 20% drop. The challenge there is that 20% is twice the 10% that I told you a while ago with the coins. But the problem is to get back from 4 to 5, 1 apple out of these 4 would be 25%. You'd have to get a 25% gain just to break even if you let your portfolio drop that 20%. That begins to be more of a challenge. See, we doubled the downside from 10 to 20, but it didn't double the increase that we needed. We didn't go from 11.1 to 22.2. We went from 11.1 to 25% rate of return necessary just to break even. So then if we go even further and we go back to these tennis balls, and I mentioned this at the outset, that we have 3 tennis balls, and if we take 1 away, now we're down to 2 tennis balls in there, right? And it is a 50% gain. 1 divided by 2 is 50%. It's a 50% gain you're going to need just to break even on your tennis balls. That's some serious math there that you're going to have to make up if you don't allow your decision process to lead your portfolio and how you do it. And the whole point is you can't let big losses occur in your portfolio. Big losses are devastating to your capital and very difficult to make up. Finally, let's just go with these 2 exercise balls. 2 balls, you lose 1, you're down, you've lost 50% of your portfolio. What it takes to break even is 100% gain. 100% just by simply letting something drop 50%. You can't allow things to work against you in that way and expect to do especially well in the market. So as you think about your investment process, what I encourage you to do is whatever investment decision you make, write down what you were thinking when you were making the decision. Write down what your expectation is on the upside, but also use a numerical value to put a leash, not a leash, a lead around that thing so that it won't get to the point where the math is working against you in a very difficult way. So hopefully today you've understood a little bit better about the math that works against you and why risk management is almost, maybe it is more important than investment selection. You need to be very cautious at how much risk you'll allow into your portfolio. And by doing that, you'll begin to see your performances improve. Hope you're having a great day, and let's get back together soon.